Good morning, everybody. So I was talking to my wife, Teresa, and I said, for the missive this week, I think I'm going to talk about the re-inversion of the inverted yield curve. And I saw this look of horror come over her face. Like, you're going to do what? What are you talking about? But honey, it's important. And so, knowing I'll probably make your eyes glaze over, I'm going to do this anyway, because it's actually kind of a big deal. So here's where we've been. Let me set this up. Let's say you went and you got a 1 year CD, and the CD was paying 4% interest. You'd expect a 5 year CD to be paying, I don't know, 6, 7% interest. That would be normal. We have had it upside down now for over 2 years. Well, really right at 2 years, 24 months. Where we've had a 1 year CD or 1 year treasury bill interest paying more than the 10 year. Wouldn't that make any sense? Unless something's off. And we've had something off, this inversion, for 2 years now. That is the longest inversion in history. Even prior to the Great Depression, something was telling you it was off because that curve was inverted for 21 months. We're at 24. And so you say, well, how does this happen? Well, there are distortions that happen, and money moves differently when an economy is distorted. Well, Greg, what distorted it? Well, COVID. You see trillions of dollars pouring into the economy. You saw the economy really get out of whack where Main Street was performing one way, which was okay, but that wasn't cranking. It wasn't going great, but it wasn't tanking. Meanwhile, Wall Street's ripping higher. That was a disconnect. Regardless, an inverted yield curve where short-term interest rates are higher than long-term interest rates tells you something's off. Now, here's why it's important. Recessions don't begin when the curve is inverted, at least historically. Recessions begin as it uninverts, as it starts to go back to normal. Now, there are two ways this can happen. So let's pretend you've got your short-term rates here and your longer-term rates down here. Here's how it could uninvert. You could have the longer-term rates rise, like your 5 year, 10 year CD. The interest rate rises. Well, this one comes down at the short end, and you're back to normal. If it happens that way, it's telling you that the distortions are being corrected in a healthy, good way. Now, there's another way that it could happen. Remember, we've got rates up here, rates down here. What if that short-term interest rate drops really fast and it comes down this way? Meanwhile, the long end kind of stays where it is. You still get it uninverted, but that's telling you a much different story. That's telling you we're in for a hard landing. Things aren't healthy. We're not growing out of this the way we should. We're actually seeing something, things are going to go poorly. That's why this is important. The yield curve for the last several weeks has been kind of uninverting, and now it's uninverting really fast with this end coming down. And this is what Jerome Powell said this week. Well, we may not be hiking interest rates here in July, which he didn't, and we didn't expect he would. But we're really keeping a hawkish lookout for next month that we're willing to drop interest rates. Well, the market looked at this and went, oh my gosh, here comes the hard landing. And you've seen stocks this week just get hammered. Meanwhile, in anticipation of rates coming down, gold is popping up. So I hope your eyes didn't glaze over, but something big is happening in the bond markets that it's forcing these interest rates to go back to normal in a way that's telling you interest rates are going to come down. The reason interest rates are going to come down is the Fed's going to feel compelled to stimulate the economy by dropping rates. And that's what Walt and I have been anticipating for a long time, and now we're starting to see it play out. So with that, I will turn it over to Walt.